Good morning, good afternoon, good evening, whenever you are watching this week's video. Hey, and my volume is on. Oh, oh. All right, so I am none other than yours truly, Patrice L. Berry, EA. And we are a couple of days away from Christmas. And even though I'm looking like a whole gift, a whole WHOLE gift, because I realized how that sounded. That didn't sound right. I need to enunciate my words better. Right? Look at the ribbons. It's not Christmas yet, but we getting ready to break some stuff down on these tax returns. Y'all probably are like, Patrice, just go and take your break. We know you got 3 weeks off. We know you doing a countdown. We know you trying to get your entire life together. Go ahead and just, Patrice, just take the break. Take a nap. Y'all, I'm trying to remember because mentally, I'm still at Thanksgiving and chilling. But physically and the business side, which cortex is that? Left cortex? Right cortex? Whatever side of your brain that's analytical is out here being like, okay, you got to get this done and this done and this done and make sure this work and all this done and check this stuff off your list so that you can woo-saw when you need to woo-saw. All right, so what we're going to do is we are working forward on this 1040. Why? Because y'all, we already talked about the queen. We talked about her cousin. We talked about the Kang. And now we got to talk about what you owe them people. Huh? Yes. We doing all this to figure out what you owe these people. And I'm going to go wax deep on what it is that you need to do. All right. So, of course, y'all know I got to take you to the screen. Why? Because the screen going to show you everything. Now, we are now in section on a 1040. We are on section 16 through 24, lines 16 through 24. Why are we on these lines? Because they importante. They importante. Because this is the piece that everybody really care about. When you come to me for a tax planning meeting and you like, but Patrice, I really want to make sure I don't owe these people too much money and this, that, and the other. This is the section I'm talking about. Right? This is what everybody really cares about when they do a tax planning meeting. When in reality, tax planning is more so about strategy. At the end of the day, I don't care how much money you make. I don't care how much money you keep. Human nature is, hey, am I going to get a refund or am I not going to get a refund? And how did you determine whether or not I'm getting a refund or not? Because people really only care about a projection. And the only way to know that is I'm going to give a projection or estimate about what we think you owe them people, which is line 16 through 24. So we're going to talk about it. We is going to talk about it. All right. Now, let's go through this at a high level before we go to the IRS page and figure out ways that you can use this and leverage this and tools that are available to you so you can actually get in front of some of this stuff. All right. So we have tax, that's on line 16. We have amounts from some schedules, and I probably should go back and give you some detail on some schedules. We're going to give you some snippets so you can go and look at what Schedule 2 is versus what stuff is on Schedule 3. All right? Child tax credit or other dependents, because you got dependent care credit, right? And then we got other taxes. So really, tax is calculated on line 16, line 19, line 23 to give us our own tax. And in this, you're going to see, what I tell you is basic math. You're going to see some add, that's line 18. You're going to see add, that's line 21. You're going to see subtract, just for us to get to where we need to get to. And then we add, right? So, it's basic math. We ain't even multiplying over here. We're not even multiplying. All right? So, let's take a jump over to, I'm trying to figure out before we talk about tax. Let's start at the beginning. Let's start at line 16. How are we calculating it? Let's go there. All right, let's go there. All right, federal income tax rates and brackets. We are a progressive tax nation. So y'all can see my face. I didn't make up the rules. Y'all go holler at Congress. Y'all let me know how it work out for y'all when y'all talk to Congress. You let me know how it's working when you talking to your representative and your senator and what they saying. This is Congress over here voting on this stuff. That's how y'all got the one big, beautiful, or ugly bill, depending on who you asking. Not me. I'm just explaining the information and breaking it down for the peoples in the back. Not you. The ones in the back, because you're going to share this with them. All right? All right, so you pay tax percentage on your income in layers called tax brackets. As your income goes up, this is where the progression go, right? The tax rate on the next layer of income is higher. When your income jumps to a higher tax bracket, you don't pay the higher rate on your entire income. You pay the higher rate on a part. That's only the part that's in the new tax bracket. So let's look at it. Let's see what we're talking about. Because everybody, I don't want to pay this. How much my effective tax rate? Where's it? Y'all don't sound like that. I'm not whining. Okay, so let's look. This is 2024 rates for a single person. So these are our tax bracket. These are our tax rates. We go anywhere from 10% to 37%. Currently, 37% is highest. So when you're looking at this, this is progressive, right? So you're gonna pay 10%. What this really means is on the first $11,600, you paying 10%. Remember, this is on taxable income. What did I tell y'all? Because y'all gonna be like, Patrice, all of my money? No. The Kang. This is why the Kang's so important. Go back to last week's video. Come on, keep up. This is what's going on. So when y'all hear me talk about we go to tax tables and figure out the calculation to get to 6, this number 15 get us number 16, y'all. Keep up. All right. So after that, anything from 11,601 to 47,150 is getting, let me put my arrow here, is getting taxed at 12%. Then anything between 47,151 to 105.25 is getting taxed at 22%. It's progressive. All right. 24%, same thing. So look at the chart. We're going to give you the link. Always going to give you the link. All right. So here's how that works for a single person with income of 58% per year. 58%, this portion is taxed at 22%. Follow the thing. Why? Because it falls in between there. 47,150, this portion is taxed at 12%. 11,600, this portion is taxed at 10%. So what is it saying? This is how much the person makes. So anything from 0 to 11,600, that portion is getting taxed at 10%. Then between 11,600 and 47,150, that portion is being taxed at 12%. And everything between 47,150 to 58,000 is being taxed at 22%. So all of it's not automatically being taxed at 22%. It's graduated. So we got, let me see if they do the math down here, right? I should actually take the time to do the math, right? Because now we're doing 47,150 subtract 11,600, that difference, that's what's being taxed at 12%. The difference between 58,000 and 47,150, that's being taxed at 22%. That's how this works. All right. And then you see that filing status, something I did not go into. Don't beat me up, right? I think, y'all, I think I've done a video on knowing what your filing status is. If I have not, and y'all want me to go into detail about that, y'all know, hit your girl up. I will go into more detail about it, but let's get into it. Married, filing joint, or qualifying surviving spouse, has their own schedule, married, filing separately, head of household. These are filing statuses. Single, married, filing joint, married, filing separate. All these things matter. That's all to say. All these things matter. And if you want to click on it, it tell you what their rates are compared to what everybody else's rate is. Okay? So if you want to do a comparison of the charts, you're going to be like, oh, what? Single? What? Married, filing joint. Because y'all want to know the trick? They doubled it. Math be mathing over here. Is everything times 2. All right? Those rates. But then let's look at married, filing separately. What? Married, filing separately should look rather similar. Sort of, kind of. Not 100%. It starts out very similar, right? Very similar to single. Then we get down here and it get kind of wonky, right? And then we got head of household. Head of household is really in between the other two, between married, found jointly, and all the rest of them. Okay. All right. It's slightly higher. So your filing status matters. But let's look at the tax tables because I love me a good tax table. And I'm not going to look at 2024. We're going to look at 2025. What? Our standard deductions matter because filing statuses matter, right? So the standard deduction for 2025 is $15,000. For married, found a joint, we now at $30,000, meaning that, so y'all can see my face, meaning that if your itemized deductions exceed $30,000 and you married, found a jointly, then, and it's beneficial, we're going to go with the itemized. If you're working with me, I'm going to go with the higher amount because it's going to reduce your taxable income more. That's me. Unless there's a reason for us not to use it and we got to use the standard deduction. But now y'all know what the standard deduction rates are for the upcoming year. $15,000 single, $30,000 married, found a joint, $15,000 married, found it separately, head of household, $22,500. We got slight increases based on inflation. Y'all don't get me. Okay, so we got marginal tax rates for 2025. The top tax rate still is 37% all day. And it tells you the range. We're going from 10% to 37% based on what these income ranges happen to be and where stuff is going to start getting taxed at. I think it was $11,600 in 2024 is 10%. Now it's $11,925. We adjusted slightly for inflation. Okay. All right. We got alternative minimum tax exemptions. I don't go into ATM too much. I do have clients that do fall into this category. Take a look at it. We got earned income tax credits. We can already talk about the credits momentarily. Qualified transportation fringe benefits. Now y'all back in the office. This is a thing. And health flex spending, cafeteria plans, how much you can put in versus what you can't. Y'all remember that a flex plan is not the same thing as an HSA. An HSA, you get to hold that money and carry it over year to year. A flex plan for spending, you got to use that money by the deadline. And in most cases, that deadline is tax filing day. All right, spend your money. Don't keep that money in a health savings account, in a flex, not a health savings account, in a flex account. Can y'all tell you? It only take anybody who has ever had a flex spending account because they don't have a high deductible and don't have an HSA. It take you one time for them to take your money. Ask me how I know. When I was working, I had both HSA and a flex spending and would do certain things because my money, I would put my eye money, my eyeglass money and stuff like that and dental and some of that stuff in a flex plan, and then other stuff. I did dependent care and then I had an HSA. It take you one good time to not spend all your flex plan money. And when they take that money and you be like, oh, because you was saving it like you was going to spend it. Go to the doctor, y'all. Spend the money, please. If you got a flex plan, not an HSA, spend your money. It is your money that you set aside specifically for that. Don't let the people take your money. Woo, because you will be sick. And you ain't even go to the doctor. Now you ain't got no money. I digress. Medical savings account, foreign earned income exclusion, estate tax credits, all of these. These are telling you the limit. So we're going to make sure you get this page as well. You don't have, y'all, I feel some kind of way about this. I would love my personal exemptions. I would. Right? And then, but I do like this. I'm not going to lie to you. Itemized deductions. Y'all see this? This is what I'm feeling. There's no limitation on itemized deductions for tax year 2025, as in tax year 2024 and proceeding to tax year 18. We was limited. The limitation on itemized deductions was eliminated by the Tax Cut and Jobs Act of 2017. Come on. The thing I love about this now is because my SALT, my state and local taxes, because everything need a little bit of seasoning, is not capped at $10,000. Y'all look at my face when I say it. What? I love this for us on the one big beautiful bill. That's the only thing that made me feel beautiful. Because that $10,000 in the state and local taxes was having your girl feel some sort of way. All right? And in lifetime learning credits, there are income limitation adjustments. Please do not get mad at me. Know your numbers. Let me let y'all see my face. Know your numbers so you won't get mad at me. Please give me the information, but understand if you can't take it on your tax return as a credit or a deduction, that ain't got nothing to do with your girl. That has 100% to do with the rules. Not me. Not me. Not me. Okay? Now, let's look at these tax credits. So these are some of the things that are going to end up on those Schedule 2 and Schedule 3 that are on those lines, those other lines for the tax return, right? And I want you to be prepared of those, and we're going to make sure you get these as well. There is a difference between refundable and non-refundable credits. Refundable credits, and I'll come back to this, right? Because Patrice like, refundable credits meaning that if you have maxed out, you have no income, everything, you can still get a refund. It is going to send you, that credit will not cap itself out. It will send you into a phase where you can actually get a refund. And non-refundable credits meaning it can lower your tax liability down so you can break even, but it's not going to send you into an ability to get a refund. It's going to stop you at zeroing out your tax liability. That's all it says. Okay? All right. Some tax credits are refundable. If a taxpayer's bill is less than the amount of refundable credit, they can get the difference. That's a refund, right? And then some taxpayers who aren't required to file may still want to do so, right? You might not be required to file because your income limits don't require you to file, but you could be entitled to some of these credits here. So don't sleep. Get your monies if you're entitled to your monies. But a non-refundable tax credit is once your tax liability is zero, that bottom line, line 23, is zero. Not, is it line 23, 16? Yeah, 23. The taxpayer won't get any leftover money. It's going to take you to zero and that's it. You're going to cap out. That's it. You're not going to get a refund. That's how it works. So you got to know what's refundable versus what's not refundable. All right. Earned income tax credit is a refundable tax credit. Okay. So we have some people that you might not have enough to file, but you want to get your earned income tax credit. And we normally do not file those until way after President's Day. So February, because they flagging stuff for this. They're going to get you no game in the system on this. The child tax credit is non-refundable. Okay. But if you're entitled to it, it'll get you to a percentage, do what we need to do. All right. American Opportunity Tax Credit. That is some of our education credits that we need to consider. And then we have other lists of credits that we get to consider that's happening in that tax and credit section, right? That's 16 to line 23. Other tax credit, family and dependent care credits, income and savings credits, home owner credits, electric vehicle credits, while we still have it. If you have solar energy and stuff like that, it's happening there. Healthcare credits, all of that is happening there. There are interactive tools that determine, y'all know I like an ITA. I actually did, what? Come on now. I actually did a video on that this summer, I think, about these tools that you can use that are built into the IRS website that'll help point you in the right direction. So if you got them, check them out, because why? They important. And here's the list. So we're going to make sure you get this too. Education credit, child tax credit, premium tax credit. That's dealing with those healthcare stuff. Child and dependent care credit, elderly or disabled credit. And there's some stuff in the One Big Beautiful Bill for seniors that we're going to make sure that we can leverage. Retirement savings contribution credit, claim a credit for adoption, foreign tax credit, and then first time home buyer credit, or if you got to repay it, right? If you're not sure what to do, come to this page. Come to the page, check the page out, or shoot us a question. Set up a consult. Yes, you may have to pay to have a conversation, but I promise you, I'm going to make it worthwhile for you. I promise you. I'll make it worthwhile. It will be virtual, but I'm going to make it worthwhile to make sure that you educate it. And if you're one of my clients and you're not sure, I need you to go back and I need you to go look at those lines. Look at that. That is determining how much money you owe them people. And it's based on a range. What? You kidding me? No, I didn't make the rules up. It's based on a range, and I'm trying to see if it give us the tax table. It's gonna actually give me a copy of a tax table so I can show y'all. Because it's usually one in the back of 2017. Oh, here we go. Let me give you an example real quick, and then we're gonna close out. All right, so this is in publication 17, and it's saying, hey, if your filing status is one of these: single, married, filing jointly, married, filing separately, head of household, and we get to your taxable income, it's determining what your tax liability is going to be. Y'all take a look at this. So not all your income, but your taxable income. Now, some of this gets calculated a little bit differently based on if like you have long-term capital gains tax and things like that. So those calculations are built in there to get us to that point. And you may not see it dollar for dollar, but I need you to pay attention to this because it gives you your range and it gives you an idea of, oh, I got to at least pay this much in tax. But that's why you need to know those calculations, and we got to have an idea of what your taxable income is supposed to be, because we want to be sure that at the end of the day, we're withholding enough money based on our filing status. That's why this stuff plays in. This is single. This is married filing joint. This is married filing single. This is head of household. Married filing separately and single, you'll see a correlation. And a lot of them, they correlate up to a certain amount. When we start making more money, then we start to see stuff it start to adjust slightly. I'm trying to see if I can get to higher incomes. Yeah, you'll see it. I'm trying to go to the end of the table because I normally like to give you the difference when we get to, let's go mid-tier, right? So you'll see $60,000, $59,000, right? $60,000. You see that a single person and a married filing separate person, they pay $8,039 in tax. That's their tax. Whereas to a married filing joint person is paying $6,619 and a head of household person is paying $6,752. I don't make these rules. These tax tables are important. You got to know what your tax liability is. And if you ever ask me and you like, Patrice, why do you say when we go to the tax tables and it phases out at $100,000, I'm going to prove my point. Boom. Because at $100,000, it phases itself out. Period. And then I got to do calculations because the instruction tell me to do it. $100,000 or over, use the tax computation worksheet, which is listed below. And the software is doing it in most times. It's doing that graduated amount. If it's between this amount and this amount, this is how much you got to pay. If it's between this amount and this amount, and that's how we figure out what our tax liability is. Believe it or not, y'all, back in the day, I had to do this by hand. I did tax returns by pencil and paper back in the day. When I learned taxes, I feel like I'm like back in the day when I had to walk in the snow for 5 miles and it was so cold. And back in the day when I first learned, when I was in school, when I was getting my accounting degree still, and this is 1990, I graduated college in 1999. 1999. Purple Rain. Yeah, I did that. They probably not gonna even edit it out. But we did stuff by pen and paper. Pencil and paper. When I did VITA, we did stuff by pen and paper and 10-key calculator. Without the tape. Calculations on some scratch paper. This is why I tell you that taxes are just addition, subtraction, multiplication, and division. I've taken calculus twice. We ain't doing no derivatives. I might gotta solve for something. I might use algebra, but not that much. I ain't pressing that hard. But I want you to understand where it's coming from. We got to figure out where stuff is. We got to do some stuff to subtract. We got to figure out if we got some extra credit. We got to figure out how it all lines up, because at the end of the day, I can't do but so much wiggle room back here from 16 to 20. I told you 23. To get to line 24, I can't do but so much. I can't. It's out of my control. because I got to start following rules so we can determine what you owe them people. And so next week, what we're going to talk about is what you paid them people. And so we'll go through from line 25 to 33 because that's going to let you know, hey, this is what's left. And then you can be like, oh, so after we do the stuff at the top and we've determined and projected out what we owe them people, which you can also use the IRS withholding estimator, because a projection is just that, an estimator. And we will give you the link to the IRS withholding estimator and some of these links to stuff we got in here and that we showed you today, because what you pay them people need to be as close as possible to what you owe them, because that's determining whether or not you are getting a refund or if you're going to have to stroke them people a check. Let me know if this was helpful. Let me know if it puts it in more perspective and you understand the aspects of the tax return a little bit better. And if there's questions that you still have, holla at your girl. Holla at your girl. We will have one more video to break this down and close things out right before the day of Christmas. So Christmas Eve, that's going to be my gift to y'all. Don't say I ain't never gave you nothing, because I did. I loved on you real bad, because I'm here to make sure that you are in a space that allows you to help us, help you, help yourself. Until next week, peace. I'm out, y'all.